So which sectors are you currently bullish?
Currently, it's only
How did you look at stocks? Did you avoid or did you still buy or sit on cash? How did it work?
I have kind of converted it to make it easy for everyone. When you buy a company, can you
Did you buy any new age business in the last 3 to 5 years?
if you can do the math, you can figure out that there is.
Today, we'll be having a conversation with Mr. Manish Chokhani. Manish is a chartered accountant and an MBA from London Business School. Manish has over 3.5 decades of experience in the Indian markets. He has been working with the top minds across India in the investing space. He sold, along with his partners, his business to Axis Capital, wherein after that he has been managing his proprietary capital and that of his partners.
Hi Manish sir, thank you so much for accepting our invite to be on this podcast. Really a wonderful experience sitting with you, and I'm really excited to have this conversation with you. To begin, for our audience, can you just give a brief about yourself, like where did you study, how did your career evolve, and like what were the key milestones in your career?
Okay, first of all, thanks for inviting me to your podcast. Take me back a long way. So I grew up in a business family. My father used to run a paper and then a flexible packaging company. And my training in whole life was to go into industry. And I didn't, till my college years, I wasn't really bothered or thinking about the stock market. So I started by studying CA because that would give you a grip. Because with that, you should think you either need to come from the technical side, which is engineering, or finance or marketing. So looking at the aptitude, we went into CA. And even there, I took mostly internal audits to figure out how companies were working from the inside, because I wasn't ever expecting to be a tax consultant or an actual statutory auditor. Having done that, I realized we needed to broad base the view, because CA can be very here and now. And so I managed to get it to a few of the top MBA programs in the world. I eventually went to London Business School. I did an MBA. Came back from there. By the time I came back, the business was in doldrums over here. So I spent a couple of years going around Nestle and Hindustan Lever, who are our customers, and realized this is not the space I can spend the rest of my life. Dad was kind enough to say, you can find your own way. In that journey, I happened to meet the founders of Enam, and Vallabhai, who's been my mentor. He said something which kind of was the moment of epiphany. And that day, I just started working with him. He basically said, Beta, you come from a business family. You will find an opportunity. You will then build the management team around yourself to take advantage of that opportunity, and you'll have ownership of that business. But in that era, which is 1990 now, the exit may not be that easy. But if you bring that mindset of looking for opportunities to the investment market, you will get ready-made management teams to choose from. And then you can take as much ownership of these companies at prices which work for you. You trade off in your mind that you will not have control, but you will have exit. And the other benefit you will get is you can take the boom of different industries. You don't have to be stuck to any one. So if you come with that mindset, then I think you'll have a great time here. I basically told him, when can I start? I'll start tomorrow. We had no terms. I carried his bag literally as his assistant. And he and Nimish Bhai and others, they were kind enough over time to make me a partner in the firm. And that's how I grew. So it was a very entrepreneurial young firm which was growing, very much like how you all are today. So I went and built the whole foreign brokerage business for the FIIs who were coming into India. Through them, I got to visit, I think, probably 1,500 companies in the 90s. We also helped one of our clients to set up a fund in Mauritius as early as 94, when I'm like 28 years old. So a lot of freedom to go and set up all that. By 98, we had set up an asset management business as well, because by then I was fed up of doing broking and giving ideas away for back then 1%. So why can't we do it ourselves? I ran that with a partner, Jiten Doshi, who's still running that business. And then by 2002, Vallabhai asked me, can you come and run the investment bank? So I ran the investment bank in the early 2000s, at which towards the end of that period, 2008-9, we had a lot of suitors from abroad, JP Morgan, Nomura, Citibank, and so on, to basically come and partner or take us over. We eventually chose to merge with Axis Bank, and whatever time it took in that merger through RBI, I went and I ran that firm then, which was merged Axis Capital for a year before handing off and coming out back to the Enam partnership to invest, which is really what our first love has always been. Also briefly in that period, 2013 to 19, I was involved a day a week with TPG, which is one of the world's largest private equity firms. I spent a day a week with them, investing, learning with them how they're investing over the world. I served as chairman for their growth investment fund over here, basically to help them get in people who would like to deal with someone stable or keep someone odd out of the door. So that's kind of a quick summary of where I was and where I am.
Great. Really inspiring to know, especially like I'm also C and I really look up to you.
That's kind.
And like apart from the investment management side, I look up to you very highly on the behavioral aspect as well.
Sure.
That you have written a lot about Vipassana, and I'm sure there's a lot of content out there available. So let's move forward to your where you said that you quit Axis Capital, where you were running an investment bank at that time, right?
That's right.
Investment bank.
Axis is the full service investment bank.
Full service investment bank, right?
The 3 or 4 large Indian banks. At that point, we were mobilizing, I think, a quarter of all money being raised in India.
Okay.
So we were like the gynacs who are delivering the baby. And because I come from industry and the firm's DNA was as an investor, you always saw it from the company's perspective of what can happen and what would be right for investors as well. And that's why in the distribution chain and in the investor community over time, the firm's name, which was Enam on the initials of the founders, got pronounced as Enam. Inke issue mein dalenge to Enam milega. But by and large, we were trying to back the newer companies which were coming to market to create the new India, which we saw.
So back then, it was largely around merchant banking, investment banking together, taken together. I'm asking, is that correct?
Yeah, so
IPOs,
equity capital markets, mergers and acquisitions, private equities, institutional brokerage, and retail brokerage, along with a finance subsidiary, which will give lending options to some of the clients as well.
And since how long after your merger with Axis, for how long did you manage over there itself?
I spent a year with them because the terms of the deal were that we will come and hand off so that they can then
Take
put in their own CEOs. But we were not really interested in running it for much longer.
Got it. So it was 2012 when you quit.
2013 November.
Yeah. Got it. So after that, did you manage any public money?
No, public money I was managing briefly in the period 98 to 2001, which was the real TMT bubble period. Otherwise, I've chosen to stay away from managing money because I think investing as a business and investing as a profession are distinct. We can talk about it later. There are some lessons I learned in that period where, money managers tend to do things in a certain way, which may not always be right either for the investor himself or for some of their clients.
Got it. So you have been managing your own proprietary capital, which you made out of selling to Axis Capital, right? So how is the structure right now of the firm that you are managing?
No, Enam now is a partnership, which is a loose alliance, I would call it, of the former founders. Enam Holdings is really where the partners sit together. They deploy their own money. There's no third-party money. There's, of course, Enam Asset Management, which sits separately, which Jiten runs, and a lot of it is with the larger Indian families. A lot of it is the sovereign wealth funds from abroad, which have invested with him. They're doing very well. But we want a happier lifestyle, investing in businesses we like, people we like, and therefore the capital can be mobile between public and private markets.
Got it. So that business is not part of the holding company that you are managing currently. This is on your own.
This is absolutely family money.
You said that Nimish Bhai's principles are founding principles at asset management when it comes to Enam, right? So he doesn't pay a lot for the future,
right?
Especially if we talk about today's time, like especially a few months before when the markets were at peak euphoria. Now they've corrected, but during that period, how did you look at stocks? Did you avoid or did you still buy? or sit on cash? How did it work like then?
So the firm's ethos is of value investing. So this is the principles which, Buffett Sahab has taught us in terms of great businesses. And you come from Graham and Dodd school of saying, I want to buy $1 worth of earnings for 50 cents. And the way I have kind of converted it to make it easy for everyone is to say, when you buy a company, can you say that it will have a multiple of 5 times in 5 years? If it looks like a 5p stock 5 years hence, it means 2 things. Number one, you have a view on the business for 5 years. Otherwise, you have no business to own a share of anything, which is a share of a business. It's not some piece of paper which you're trading based on momentum in the market. Secondly, you have a view on the earning trajectory. So whether it's coming from volume or price or working capital turns or whatever it may be. If you get that, you pull the trigger. Otherwise, you don't pull the trigger. So most of us would tend not to be buying things in a very trending market.
Okay.
People could be trading in that market, but they would not have built their underlying positions in the midst of a raging bull market. The underlying positions are always built in the depth of a bear market.
Okay.
And I say this, that in bull markets, people rent stocks. And in bear markets, they return to their rightful owners. And we like to think today where we are, because our advantage against the market is we have money which is ours, so it's long duration money. So on the larger caps, I can afford to look 4-5 years out, as opposed to say a fund manager who's mark to market every quarter. And firms like yours will also measure them and put out ratios of how they're doing and so on. And which is why I said the distinction between managing money professionally and managing it for yourself gives you a clear divide. And secondly, because it's proprietary capital, whether you do private investing or small investing, you can tend to be the person who discovers a business or who helps the smaller company to actually find their feet and grow. Whether it's to help in private, like to recruit people, to determine their strategy, to help them on go-to-market and so on. So it's just fun. I don't think it's about just compounding, but process of life should be fun as well for you.
Right. So speaking of the bull markets that we recently saw, and there's a minor correction, I would say 15 to 18% in the broad, in the headline index.
Headline indices.
Of
Some
course,
things
it's
have
much
suffered a
deeper.
lot more.
Yeah, 30% at least in the smaller ones. But speaking of these indices itself, what was the maximum percentage of cash you were sitting at during these times? Since you are telling me that you...
So this market, I think we would all be between 15-20% cash.
You went...
But there were times in the earlier bull markets when, my own portfolio was very, very small. So I remember 91 December, I was out of the market completely in the Harshad Mehta crash. 100% cash.
Okay.
2001, the Infosys warning time, I think it had gone to like 100% cash. Before the 2008 crash, because I remember Bharti, L&T, which were the leaders of that market, had peaked out in August 2007. There was a Reliance Power IPO in 2008, January, 100% cash.
Okay.
So, but there were smaller portfolios then. So it's harder to do that today because you tend to go 10x every 10 years. So, I mean, what I'm telling you, 30 years ago, it was probably 1,000th of the size it was. So it was easier to do. It's not that today. Similarly, during COVID, I don't think we went cash because we didn't see it as a world-threatening event. In fact, it gave you an opportunity at that time to buy whatever you could. And it's those stocks which have given you, 5, 10x in the last 4 years.
Right. So if you had a chance to go 100% cash, would you have gone 100% cash in September last year?
That's what I'm saying. It's difficult. And again,
if you had a chance,
there are some sectors which, for example, financials have not really participated. So I would not have sold those.
Okay.
So actually, I didn't sell the financials, but a lot of the others, which is where the cash came out of.
Got it. Fair enough.
But we're not typically taking, cash calls or timing the market. Don't get me wrong.
Yeah.
But at certain times, you see the madness is just too crazy.
Right.
And at that time, if like it's a world crisis coming or a market threatening crisis coming, then it's better to once go out and take stock and come back again. And again, that's a theme I would come back to when you talk of investing as a profession versus as a business. When your client is putting money in a mutual fund, the poor mutual fund manager's job is to deploy the money. He cannot take a cash call. So he's relying on the client to say, I don't like this market and I want to get out. And most clients at that time are completely caught up in that euphoria that this market is trending and every week I'm out, I'm losing money. And they can't afford to see the last 20-30% rise in the market going away in a matter of weeks.
Right.
So that skill set, very few people would have, or that temperament. And even if you're an advisor, they will treat you with a lot of disdain at that time. And I can say like a trigger event for me was, I remember my 2000 period where we had built an anti-tech portfolio for a lot of clients early. And I remember one client calling me and he's saying, Manish, I love you. You know, all what you do guys are great. It's a discretionary portfolio. I know you'll do what is right. But I see you're holding Nestle and Concor and BEL and SBI. Can you just, while I'm on the phone, sell all this and immediately buy Satyam Computer for me? And we can always come back to this 6 months later. And that's the moment I realized I don't want to be in a profession which is going to mess with my own mind. And it's better to then get to a stage in life where I can afford to be managing my own money at the way I like.
Right.
That was a moment of transformation for me.
In 2001, when you were telling me that you went 100% cash, the Infosys warning, was it that when Narayan Murthy said on the con call that we can't be growing at 100% perpetually?
Right. No, they had guided for certain growth.
Right.
They had even gone around and met investors at that time.
30%.
And Manish Murthy was sitting in the US and reassuring people. And then within a span of 14 days, the narrative completely changed. And while you knew the tech is absurd, but remember the Infosys ADR at that time was trading at 100% premium to the underlying. Okay. So the market was egging them on to make an acquisition.
Okay.
And there could have been one or two companies which they could have picked up and then which could have been transformational for them. So in theory, there was still upside in the stock. But in practice, when things don't happen, they can go south pretty fast. And just for context, in terms of what valuation madness can occur, I think if I'm not mistaken, they peaked at a valuation then of $45 billion US.
Oh God.
In 2001, March.
Infosys.
Today, 25 years later, almost 24 years later, they are about $90 billion market cap. So it's a double in dollar terms. Of course, the rupee has collapsed a lot more, so it doesn't look like that in rupee terms. But if you're a dollar-based investor, it could have been
2 times in 24 years.
A really bad decision. Because remember, the index itself goes 4 times in 10 years.
It's less than 4% return.
So it's nothing. So if you go, let's say the index does this 13-14% compounding, you go double in 5 years and double in the next 5. So 4 times in 10 years. So 16 times and then another 5. So you could have been 80 times up from that period.
Got it. Like what you're saying, they might be great companies, but they can't be bought at just any
crazy prices. Yeah.
Right. Got it. So speaking of crazy prices, while I don't want to name any companies, but let's just take one for the sake of it for better clarity. Like companies like Zomato, Swiggy and all, they are very different from the traditional businesses. And to build a business like that, it definitely requires a lot of cash burning, especially in the initial years. But even after 14, 15 years of incorporating and 3 to 4 years of listing, these companies are still some have broke even, but are still burning cash. How do you look at these companies since the era has evolved? Our markets are becoming more mature and accepting these kind of companies. How do you look at these tech-based, tech-first companies versus traditional businesses?
See, think of all of these as platform companies. So in the earlier era, you would think of a brand company, someone who was trying to build a brand. They would take the hit on the P&L, and that P&L may not show you results for 5-6 years until the brand gets established. And you focus on unit economics and you focus on gross margins, which is after the cost of materials. And bulk of the money gets spent on what we call SG&A. After that, you can, in your mind, you can work the math and see, can this company deliver, let's say, a 20% EBITDA? And then what will be the flow through the bottom line? So if you start with, say, 60-70% type gross margin businesses, you'll end up with a 20s kind of EBITDA. And these companies, therefore, eventually when they come down to a, say, 10-15% type PAT and they get a 25-30 multiple eventually, can trade between 3 to 5 times of sales then. And if you can then get the view that I like this business and the economics and the competitive mode that they've built, and you can see that, like I said, over 5 years, how much can this company compound its top line? And by which time that operating leverage will flow through to the bottom line? And do I get my 5P at the end of it? So while the stock market loves momentum and you may see 100% growth, the fact is companies of the sort you're mentioning, again, nothing against them, but if you're buying a stock on, say, a 200 multiple, for you to get to a 5 multiple 5 years hence, the earnings have to compound to grow 40 times for me to make basically 3 to 5 times my money. So it's not a great bet for me as an investor. So it's like Buffett used to say, I'll applaud the effort, but I'll skip the ride. But this stock, again, remember, a lot of these were available much cheaper at different points, at which point the math could have added up potentially for you. So your job as an investor is you don't have to participate in every story, or some of it you participate till it gets to a point of madness where you allow someone else to take the ownership from there, because clearly their conviction or their vision of the company is either better or more long duration than yours. So we're happy to part with some of those. Even in the bull market, why do you end up selling certain stocks? Like one mental hack I always have is typical bull market stocks will fall 33%. They either go 33, 50 or 66. You'd obviously 66 means the stock is 3x more than it's worth, which is hard for characters like us to hold. So we're never going to get in that situation. But if a stock falls 33%, it means from there to come back to the current price is a 50% gain.
Right.
Would I be a buyer of this stock 33% lower? If the answer is no, then I don't mind paying the tax and moving on.
Got it.
So it gives you an opportunity, therefore, sometimes to just rebalance your portfolio or say, this is enough, let someone else make the money from here.
Did you buy any new age business in the last 3 to 5 years?
No, we did. Even like I said, in TPG days, we were one of the early investors in Lenskart, which will come public.
Right.
And again, similar concept that you work on unit economics, see what the gross margins can be, where can the EBITDA of this company end up, and what are the degrees of freedom, especially if you can take this learning and expand outside India as well. Plus, can you do omni as well as online, offline in kind of similar unit economics? Because what you trade off on delivery is the trade-off against, say, a rental of a store, for example. So if you can do the math, you can figure out that there is some serious money in some of these companies to be done. And like I said, these are platform businesses. There are very few of them by definition. And the industry tends to consolidate much faster than the traditional industries.
Right.
Like today we love, say, cement or the electrical guys who have all been, 10 baggers over time. Because over time they consolidate down and the top 5 players become 70-80% of the industry. You get pricing discipline and that flows through then to the bottom line. Well, a lot of these new companies, because the platform doesn't allow many more entrants to come in, you get a fairly consolidated industry fairly quickly.
Got it. So how much of Enam's proprietary capital goes into unlisted startups?
It again depends. Like I said, there's no commonality in that sense. So if you would ask me 10 years ago, I was a lot more adventurous than I would be today. I'm happier to be compounding 14-15% now. I'm not looking to keep hitting the ball out of the park. My son is 30. He takes a lot more risk. He invests in tech companies. He invests whatever he can overseas. Akash is younger than all of us. He invests a lot in private companies and so on. So there's no hard and fast rule. You want to like the opportunity, you like the person running the business, and think about culture, values, and capital allocation going ahead, because that's the partner you're entrusting your money with, and take a call based on that.
Got it. Your partners, Nemish and Manik Bhai, have different point of views when it comes to selling. Nemish Bhai is value-oriented in selling, and whereas Manik Bhai has a different selling style.
He passed away more than 20 years ago, but I learned a lot from both of them. Nimish Bhai also been my guru and continues to be. So Nimish Bhai has been the ultimate value investor. He's very price focused and he's very happy if someone else makes the money, after he's reached his target prices. He's also held companies for 20, 30, 40 years. So he's seen drawdowns of up to that 33% in many cases as well. But he's very, very value driven. Manik Bhai's case was, I had mentioned in one of my interviews, which is where I think you picked it up from. So I used to come from value school, and back in the 90s, I was one of those early tech type investors. So I had all these Infosys and ZTV and Max Telecom and Ramco Systems and all these kind of companies in the portfolio. And there was a period, because we had IPO'd Z, I think in 91 or 92, I forget. And it had come down to a price, I still remember it was about 70 rupees on a 10 rupee paid up, which gave it a market cap of somewhere around 140 crores. Imagine the whole of ZTV was available for 140 crores in 98, which is 5-6 years after the IPO, and they were doing well. So I thought there's a no-brainer and I should buy as much as I can, which, in my context was, few lakhs. It didn't have that kind of money. So bought a sizable chunk by my yardstick of that company, and within the next 18 months, because the TMT bubble had started building by 99, 2000. Stock was up maybe 12, 13 times.
Okay.
I thought this is the math which doesn't now add up, and I should take my profit and go. 800 rupees, I start selling it, and Manibhai is there and he's watching and he's like, Manish, I don't think you should be selling this. I said, no, I know this business. I counted it. I made 12x, I'm out. He said, you sell it and I'll tell you some lesson which you learn. The stock, just for context, this is the Ketan Parekh era. It went in the next 3 months from 800 to 16,000. Now, just imagine if you have put, say, 10 lakhs and made a crore, that 1 crore would have become 20 crores in 3 months. So the lesson you learn stays in your head. So he said, you watch in a crazy momentum market, you have to let the market tell you the right price. Don't try to be a know-it-all. And you watch for rising top, rising bottoms. As long as that formation is on, you sell it from your fundamental portfolio to your technical portfolio in your head. And once you see the turn, just get out. Then don't start justifying the fundamentals and so on, which is what helped us sell our tech stocks as well afterwards.
Got it.
Like you could write it a bit up and then also sell a lot of them.
So even if it goes beyond fair value, you can stay.
It went,
Way above its fair value.
way above. 20 times more than fair value.
Right.
And it did eventually fall. It came back to, I think, that same price. By 2001-2, it was back at that price.
Okay.
So you may have been right, but to have that euphoria, and at some point I would not have got 16,000, but let's say I got out at 8,000 or 9,000 on the way down. It's still 10x from where I sold it.
Right. So you would have,
that was really his lesson.
so you are waited until 16,000 for it to make a peak and then
Turn.
sell.
It
when
turns, it will fall.
the
33.
turn is confirmed.
It
That's
typically, like how it's happening in our market, the market corrects 20% down and then you get typically a rally, at which point what they call technically the smart money or people who are trapped start selling. And from there, it either declines fast or it goes into a slow, gradual decline.
Got it. How does Enam leverage quantitative analysis while...
So we are the old-fashioned Buffett school, that when Buffett, he describes it very well, that your margin of safety should be wide enough to drive a truck through it. So while we will do our quant and this, that, and really see where can this company go, I need margin of safety that the probability of losing capital should be close to zero.
Okay.
That's the first principle. I'm not trying to maximize. But on the flip side, the possibility of making a lot more should be there. So as you said, downside is limited and upside is unlimited. That's the time you pull your trigger. We don't have to buy too many things. If I buy 1 or 2 things a year, that's quite a lot of activity already. But you do your preparation every day. And again, like a fund, we don't need to own 50 stocks. We don't need to be benchmarked to the index. There are periods where we can go through dramatic period of underperformance. Doesn't bother us as long as the business is compounding. The stock returns eventually will catch up because they will tend to mirror what the stock is doing. I myself came with a very quant background, and I also came back with beta and then smart beta and sharp ratio and everything. I must tell you, in our markets, especially in the smaller companies, it doesn't work because the movements tend to be so volatile that volatility will get you to sell those stocks and do the exact opposite of what you should be doing. So actually a decline in a stock which gets it to below fair value will make a lot of the quant guys end up doing the opposite of what they should be doing. As in they will be selling it at the time when chaps like us will be buying it. So not to disparage, there is a room for quant. I myself run my own screeners to see where I am and in context of the market and sectors and so on. But eventually investing or running a business is about common sense.
You got it.
And again, if your business earning and your business net worth and return on equity is eventually what determines value. The stock market is like, we give the analogy of the man and the dog. So the earnings is the man, and he's got a dog on a leash, and that dog can go all over the place, which is the markets. So you don't let that determine and get your eyes off the ball, which is where is the underlying business and underlying earnings going.
Got it. Since you're talking about margin of safety, and from what I could figure out from the conversation we have had so far, you have constantly been speaking of 5P, right? Of course, we don't get businesses at 5P, but
No, you do.
eventually...
You'll be surprised.
Okay.
You'll be surprised. You do get them.
How do
You do get them. No, I'm saying 5P is 5 years out.
Right.
Because in that 5th year, if it's a average business, you'll get a 15p. If it's a good business, you'll get 25. And if it's a great business, you may even get north of 30. So that 5p at least gives you the chance to say, I will make 3x my money. I should possibly make 5x, which is the band of return I'm looking for. The 3x in 5 years is my 24% compounding. Otherwise, why would I want to deploy my capital? And if I can make a 5x, I'm close to 40% compounding, which is what a lot of us have done over here for 30 years. So you do get it.
Okay.
And it's not 5, don't get me, I'm not saying you buy a cheap company today.
5 years forward.
Often a cheap company is a value trap. So I'm not necessarily saying you buy the 5p. Like you could buy all the PSU banks at 5p.
Right.
And you must have a view on where will the earnings be 5 years out from here. It may well be the same. But will they ever get to a 15 or a 25p? I don't know.
Got
So as an example.
Got it. So you're saying 5 years forward,
Right.
even if it is 25 today or 20
it could be 25 today. Can it get to 5 in 5 years?
Got it.
I mean, Nimish Bhai in the old days taught me, can this company earn its market cap back ever in your vision?
Okay.
So if you're buying this company, let's say the ZTV example, if you can buy the whole company for 150 crores, will this company ever make 150 crores? Even in the next 5 or 10 years, then you have a multi-bagger.
Right.
And that's how you make it.
The markets have evolved much more than that.
No, you'll be surprised. You get fantastic chances. You'll be surprised. You just have to be patient and you must have money on that day, which is why ability to sit on cash. You know, people often will do a sell and a buy on the same day.
Okay.
Sometimes you're better off selling and just sit quiet for 1 year. Don't do anything. Go on a holiday.
Okay. Got it. Got it. So you have always emphasized on investing in good managers over good businesses, just good businesses, right? So what are your key checklist pointers if you have to talk about selecting good
Very
managers?
controversial topic because, again, there's something I spoke with your friend Kushal, I think, on his podcast. And again, I don't mean it in a religious sense, but you can identify traits of people, like how they say in Hinduism that someone has the trait of a Kshatriya, someone has the trait of a Brahmin, someone has the trait of a Vaishya or a merchant, and someone has the trait of a Shudra who's physical, neighbor-oriented. When you meet people, you can figure out, is this like just a Jnani who will keep giving you Jnana, but who won't be able to execute? I mean, ideally, you want the combination of the Banya Brahmin, as you call it. Like a lot of our tech companies, our pharma companies, our brand companies fall in that bracket. The really large empire builders in India, if you think of them, have the Kshatriya characteristic, right? The empire must grow. I have won in business 1, I must win business 2. If I have to destroy my brother, I will do it. Though I have different traits. And you can figure this out. I don't think there's an art and science to it. So when you're with a Kshatriya king, you have to go along with whatever the king wants to do to grow the empire. And what allocations they do, the king can win and the king can even blow up the whole empire. And you've seen enough examples of that in our life. For us, again, in tune with our nature, will tend to be Banya Brahmin because we are also knowledge people, but we like to be like a passive merchant. He's not going to go to war and fight. If there's trouble, you stay away from it, right? Like how we sell our stock and get out. Those types of founders, you will tend not to find in the businesses which tend to be very closely linked with the government.
Okay.
Or which have a lot of repetitive dealing with banks to borrow money or to raise capital and so on. So again, in antithesis, this is a lot of the people who come repeatedly to investment banks and bankers will tend to be the Kshatriya businesses because they're growing empire. They need more and more soldiers in the army. And the modern era, the soldiers are capital and more manpower. And the quieter people are those who are growing their businesses quietly without getting into warfare. I hope that will give you a sense. I don't want to get more pointed than that, but it will give you a sense of what I'm saying.
Got it. So you're looking for Banya Brahmins more than
In a simple way. Because you're really backing that person's capital allocation skills and his value system. Because a lot of people, once they make capital on a free cash flow type business, they can tend to go crazy.
Got it.
So
Got it.
it's tough, but that's really what the whole business is about.
Like you're saying that on meeting them, you make a sense out of what they are in terms of, these.
How will this guy behave when he's successful?
Okay. Got it. Got it. How will this guy behave when he's successful? But then are there other parameters also you look at, like education, past experience, or...
See, the fire in the belly is something a lot of people can be articulate and talk it. Some people can't express it.
Right.
But you have to pick out what is making this person tick. And where is this person wanting to go? That burning desire, what Utpal Shetty calls it, man on a mission. You get that sense from some people. This the man on, like I gave you the example earlier of Lenskart. Piyush Bansal, when we backed him, he was 29 years old. And I remember on our TPG call, I think this is going to be one of the finest entrepreneurs of India. So he didn't have like a track record where you could already point to some great success. Like today you can turn and say, oh, Bhaskar Bhatt will be a great manager and he'll build Titan and so on. But to pick a 29-year-old is, it just comes to you. I don't know how to describe it. You get a sense.
Got it. So if we talk about gold in a 25-year, 30-year basis, while of course Nifty 50 has beaten gold, but not on a risk-adjusted basis. And even if there's outperformance, it's marginally by say 100, 150 basis points. If we talk about other emerging market countries, gold has outperformed their local currency the local currency gold with respect to those emerging markets has beaten their headline indices, all of them, except for India. But even India fails on a risk-adjusted basis. So how do you look at gold as an asset class, and do you personally hold a sizable portion of your personal portfolio in gold?
So let me give you some context to this gold story. So till the Bretton Woods in the 70s, the dollar and world currencies were pegged to the gold. Then they found it restrictive and then depegged from the gold standard. And the dollar became the store of value for the world. Now, once you give power to a politician to print money, he's going to use it. So actually, even against the US dollar, against gold, the US dollar has lost sizable purchasing power. And you know our story. We were 4 to the dollar and now we are closer to 90 to the dollar. So we are like 99% down effectively against gold over that period. But when such a thing happens, you get what you call the Schumpeterian waves every 10 years, where asset classes shift. Bull market goes from one to the other. So in the 70s, you had the crazy bull market in gold, silver, oil. It peaked in 1980. And that gold price of 1980 did not come back till 2002. So 20-year bear market in gold. Silver, the famous Hunt brothers, a lot of your older readers will remember, where they had cornered the silver market and then got bankrupt. Oil had peaked. That's how that oil crisis and small cars started coming, and it was the rise of Japan. Japanese cars came in the 80s. So it went from commodities and hard assets in the 70s. There was also the Nifty 50 era of the US. Disney and Polaroid and all these companies became, darling stocks over there. It flipped in the 80s, where all these went into a bear phase. The emerging markets of Japan and Taiwan went up 12 times in 10 years. Then again, it flipped in the following era from emerging markets back to technology. And the 90s saw the rise of the TMT bubble. So remember, all this time, gold is falling, then emerging markets are falling, and tech is making the top in 2001. That's why 2001 to 2010, it was the comeback of commodities and emerging markets. That was the era where we became part of the BRICS. And India, Brazil, China, like China was making a massive top at that time as well, around the Olympic Games, which they held. And then it flips back in 2010 to 2020 period. It goes back to US tech. And tech takes leadership. And actually the Indian markets and other EMs did nothing from 2010 to 20. And that's why by now we were already talking, oh, emerging market as a class is dead and finished. When you hear those stories, you know you want to buy those assets. Yeah.
Okay.
US tech got extended with this money printing which happened post 2008, and everything got debased. So you actually created inflation in prices of paper assets. And that's why people who know that this ends, they have gone back to hard assets like gold, silver. And gold, remember, was $250 in 2002. It's 3,000 today. It's 12 times in dollar terms, which is just a currency. It's not an asset which produces anything. So it's a store of value. It's not a generative asset. So those who are over 50 all went into gold. Those who are 30 years or under have all gone into Bitcoin and crypto. This is basically a fight against the money printing presses of the central banks of the world. And this game isn't over, because what's going on in US is really how to rein this monster back in. Because 75% of all dollars in existence in the world have been printed in the last 6 years. That's the extent of debasement of the dollar. So dollar should have collapsed. But what does it collapse against? because the euro doesn't want to fall against the dollar, the yen doesn't want to fall, the rupee doesn't want to fall. So you need an alternate asset. So gold, silver, platinum, uranium, these are in massive, massive bull markets. But they are in bull markets until we find the next place where cash flows will come. So this decade, again, you will tend to find commodity type assets doing well. I think the bull market has started in China. It will come back to Brazil. It was one of my theses that India would have been the center of a bubble in this decade, which is why all these small and mid caps which have started running. I don't think the story is over. We will get this bear market rally. People will again sell into it. But the Indian story is not over yet. Emerging markets will come back to being center of, again, some craziness.
So your view on gold is that for the
So gold is really a currency and a store of value. It's not a producing asset in a sense.
Right.
You buy land, you can make a building and extract value. When you buy gold, what do you do with it except look at it and feel happy?
But speaking from a portfolio allocation viewpoint, are you invested in gold?
We are invested in the gold miners, but it's more a view on the dollar debasement. But again, you'll say that, but people can't end up owning more than say 5% in their portfolio in gold.
Right.
And even that is physical gold is actually a better thing, which all the Indians have held for years. I think have 30,000-40,000 tons of gold in India, worth maybe $3 trillion or thereabouts, if my math is right. But that's a sizable holding, which at some point becomes a ballast for India to take off as well, because there is serious wealth here. And we'll have to see a currency realignment in the world, which I've been talking for a long time. I look very, very stupid every year. But one year when it turns, this will be a massive, massive turn. Where the currencies of the West have got destroyed and debased by the politicians. And they've used this money printing power post-2008. Any crisis, they print money.
Right.
And we are the fools who depreciate.
So what's your view on gold as an asset class for the next
So
10
gold is still in a powerful bull market.
And it will
Silver even more so.
It will continue to.
I think it continues because the end of this dollar domination is around.
Got it. So since you said that when everyone was saying sell emerging markets, it was a time to buy emerging markets. So would you say the same thing for China today?
Yeah, we've all liked China for a while. We don't like it as a country. Right. In terms of what the businesses have done there and what the asset prices have reached over there is incredible what they've done.
In fact, in terms of technology as well, how
everything.
So
if you think when the first Trump government came and they started putting embargoes on China, these guys realized we can be cut off from the world. The same way the Russians had prepared for the war beforehand, that we make our economy kind of impregnable from the rest of the world. Now you think in the last 10 years, China has taken the lead on robotics, on renewable energy like solar, on EVs and the battery, the whole chain, even robotics. So whatever you could have thought were industries of the future, which we used to pride ourselves on, that we are the kings of software, they can only do hardware, they've gone far ahead of us. As a nation, they are actually, in a sense, impregnable. Their military is as strong, if not stronger, than the US. The technology strength that they now have is probably at par, if not equal or ahead to the US. So it is an economy of the future, and it's in our interest to kind of work together with them. Despite the political problems we have to find a way to work with them.
Got it. Any other asset classes which you think are overbeaten today?
This decade, I do think it comes out of US tech because they are 70% of world market cap is unsustainable position. I thought it's unsustainable at 60, 65 also. But like you say, when it bubble builds, it goes to a certain extreme. And then it corrects and you wake up and like, gosh, what were we thinking? How can we price NVIDIA, which is a capital equipment stock, on a multiple which is presuming it's a consumer stock and which will continue forever. So things will change. The Magnificent Seven have already shown you, like most of the stocks are down significantly now. It was being held by NVIDIA and maybe Microsoft and Amazon. The rest, Apple sales are already down in China, Tesla sales are down in China, and so on. So you'll see that happening.
Got it. Speaking of Indian budget estimates, the government has said that they'll invest 11.11 trillion rupees, in rupees terms of course, in the next 5 years. Which sectors do you think within infrastructure are going to work well?
Politically incorrect, but infrastructure by and large is not a high return business. You make return on equity by leverage.
Right.
And you make return on equity by managing the regulation. It's not typically a sector which I love. We love some companies because they've got the knack of how to play the larger game. As an example, the best infrastructure stock in India says Adani Port. It's not just a port. He realized he has to build the whole ecosystem around it. And it's really investing in someone who's creating a city. As a business, that's an outstanding business. Similarly, if you think of how Indians should be taking ownership of infrastructure assets, if you think of, say, what the Geo platform is now, with the whole telecom network and the media network sitting on top of it, which eventually gets a financial and a retail network on it. It may not have as yet executed well, but that becomes sectors which, if you think 10, 20 years out, you're sitting on, effectively, you are the government. So when the government started privatizing in India, we typically went and bought those assets. So say in the 90s, they privatized and they got out of TV and it went to, media assets like Z, or they got out of even airlines at that time, and you saw the rise of things like Jet Airways. They got out of banking and you saw the rise of HDFC Bank and the others. They got out of telecom and you saw the rise of Bharti and so on. They're currently getting out of all these ports, airports, energy and so on. And you will see wealth creation there. However, like I said, they tend to be politically connected, and they need continuous infusion of capital by way of debt and equity. So it's a different game to play. For example, if I were a pension fund, I would want these assets because I can think 20, 30 years over here. As a private investor, the ROEs of the businesses are basically pumped up by debt. The underlying business should not be making a return on capital of more than double digit or max 15%. Well, then it makes it expensive for the end consumer. So if the underlying return is low of the business, like I said, you're playing against the tide, where then I can buy that kind of return business in banking, which will be a 15 to 18% type return, and at a much lower multiple of book. So you have choices, and I don't have unlimited capital, but I hope that answers.
Definitely it does. So which sectors are you currently bullish on?
So, like I said, we are value guys, and we buy bottom up. We sell top down, but we buy bottom up. Currently, it's only financials which look very cheap as a sector. And there is compounding of 15 to 18% for them. They will tend to trade at 2.5 times book, because the underlying cost of capital in India for debt is less than half of that. So it implies it should be at least worth 2 times book, if not more. And in that, there are cowboy banks, and there are banks which are well run and which are going to be around and increasingly take market share. There are great capital market businesses. The exchanges themselves you can buy, private or listed both. There are capital market plays, which still India is in the beginning phase of financialization. So it's a sector which we like very much invested in. There were others which I mentioned in the past, but a lot of them have played out. So you would expect, again, going forward, India will have a consumer discretionary boom. Per capita income will only be stepping up. But a lot of those stocks are pricing that in. You thought of platform plays, which again, a lot of them have played out, and they're pricing in too much into the future, maybe more than 10 years in the future. But at some correction, some opportunities will surely arise over there. Whichever industry the government wants to back, and especially from export perspective, import substitution perspective with PLI schemes and so on, and there are people who will create things like that. So all these financialization, platformization, privatization, consumer discretionary, there are a lot of thematic things around. But personally, what I'm looking for now is for India to go into its next orbit. You will need people who will basically control their IP or their platforms, build products and build brands. As every country goes up, if we're going to be third largest economy in the world, if you think of the rise of Japan, that's when the onslaught of Sony and Toyota and all came to the global market. When you think of rise of China, you're now seeing the BYDs and the Huawei's and Haiers and so on coming out in the world, Alibaba's and so on. Same way from India, there are very few you can as yet think of. If you go outside India, you will probably see Bajaj in the emerging market areas. You'll probably see a couple of hotels like Taj Hotels somewhere in the world, but we are not really present in the world. And there are areas which India should naturally win. So, for example, if you take a Sabyasachi or a Manyavar type equivalent, there's someone like that who should be going out and capturing that market, and you have a right to win, because otherwise your products can get commoditized. And in every country, one or two players eventually emerge who can have that managerial bandwidth to go out and then globalize. Like we saw with the software services, 30 years ago, there were probably 100 companies. But eventually it came down to 4 guys who went and conquered the world. Same thing in pharmaceuticals, we became the generics factory to the world. So some of these old players will have to move from being B2B processors to being people who own the brand on the underlying IP or the tech, which I think we missed a trick. In both in IT and pharma, they're great companies which basically globalize India. But I think the Chinese stole a march over us in both these areas. Because again, Chinese are ahead in biotech as well. So we'll find something over here. So to find greatness and cheapness is a very, you need a kind of bullseye to come, and at that time we'll be ready.
Got it. So do you invest in equities outside of India?
So whatever you're allowed to legally, obviously you do. I wish it could be a lot more. But my son happened to be an NRI for maybe 6 or 7 years. So in that period, he could build up capital, and with that, managed to invest a lot overseas.
Okay.
And I do think as a country, if we're all going to become third largest and then hopefully second largest at some point in his working life, it's incumbent on all of us to understand what is happening in the world. Because events everywhere in the world, whether it's a Ukraine war or it's a butterfly effect of cocoa plantation in Brazil, it comes and impacts you. So to be frogs in the wells only investing in this market is a wrong idea, especially for young Indians. And I've told you how asset classes go to sleep for periods of time. Like China could have been the greatest economy. Post 2010, what they created was unprecedented, but the stock markets, they went nowhere for 10 to 12 years. We ourselves, after this blow up of 2007, the whole decade of 2010 to 20 was very, very few stocks which went up. So if you're not mobile in your thinking and your capital, I think we're doing ourselves a disservice. Like Japan, it peaked in 87, it's come back only in 2020.
Right.
So you could have 35 lost years, the whole generation went under in Japan.
Right. So are you bullish on Chinese equities?
China is very cheap and they are world-leading technologies, very fantastic consumer companies. They're giving a run to the money to the Western counterparts across the board.
If we look at China, their return on equities and return on capital employed ratios are pretty low, right?
For the headline companies which you're seeing, there are many companies which make 30% returns over there.
Okay.
They're very, very high returns.
So it ultimately boils down to which companies you're selecting.
Even in India, you get to real size, say your Reliance return today is sub 10%.
Right.
So the same thing will apply to the Chinese large companies as well. Also being really a communist country, they don't want someone to become that large enough to start threatening the political establishment.
Okay.
So you saw the famous case of Jack Ma, where he was kind of told to calm down after certain comments he made, and he went in the wilderness for a few years. But people who are in, that 10 billion, 15 billion type range, who are not in the hundreds of billions, there's amazing amounts of companies which are doing very well over there.
Got it. Speaking of BRICS nations, they account for 35% of the GDP, and they have surpassed G7, which accounts for close to 30% of GDP of the world economy. Is this a change in dynamics that you look at from an investor viewpoint? Do you think investing in these companies is going to be more fruitful than investing in the larger incumbents?
So, Kanan, it's a topic I've been speaking for some time.
What implications does it have for global trade and capital flows?
So, this rebalancing of currencies is something which is overdue for a long time. Like, you see the whole world order was set up after the Second World War. So United Nations is set up, for example, Security Council is set up. Same way there's all currency being tied to US dollar, which is a store of value and a medium of exchange. Post 2008, the world is struggling to get out of this paradigm. But because we've had these crises also culminating in COVID, this money printing has just continued. And normally you would have found this massive currency realignment. But it realigns against what? Because the new leadership has to be able to take that leadership up. Logically, this should have passed on to China, because as an economy, they are already larger than US. And in terms of military power also, they are at par or better than US today. But if the whole world doesn't yet have that trust in China the way they had in the US as being the father figure who will look after us in bad times, like their army would come to your rescue, their aid would come to your rescue and so on. With what Trump is currently doing may be great for America, but he's moving from being the father of the world to becoming the big brother. So this repercussion also eventually will come on currencies, because the currency is something which I should trust, which today my alternative is I don't trust a currency which is issued by Xi Jinping or by Putin and so on. So therefore they had made a move to get the new BRICS currency going. You would have heard Trump also making noises against it, which they said we will try using it as a medium of exchange, not a store of value, which is the difference. Even the Europeans had done that in the late 90s, early 2000s to form their own bloc to get out of US hegemony, because they are also 25-30% of the world, as will be BRICS. So I do think this era of US dollar domination, where 65% reserves are in US, 65% trade of the world is held in US, is ending. And the thing with crises is they sneak upon us slowly and then suddenly. And that's the counter to why a lot of people have gone into gold and Bitcoin and so on. So it's already, all the signs are there. When it happens, we'll say, oh, we knew it's coming, but we wouldn't have acted on it. So like I tell my son, I don't know when it will happen. It could happen this year or it could take another 10 years to happen, because currencies don't change so quickly. But the world is clearly looking for an alternative to, the G7 currencies. Because you look at economies, Japan is past its peak. UK, I fail to understand why UK as an economy is still rated so highly and why its currency is holding up. France is highly indebted. The Canadian, which is part of the G7, is in big trouble. Italy in big trouble. Germany, which was the powerhouse of Europe, in great trouble with half their manufacturing in autos gone. So I think there's a massive disruptive change lying ahead of us. And I think it happens in the next 5-7 years. What that means for us as, say, a country which wants to export and be part of a global supply chain, because currently we are bystanders. We are 2-3% of global trade. We are not really present in any supply chain. And every time we cry if the rupee shows some strength for a few years, we'll have to get out of the mindset of being the lowest, cheapest supplier and get up the value chain in everything that we do and learn to compete a lot more globally. So I know it's easier said than done, because I don't run a business. It's easy for me to say. But there is dramatic change going to come. And for people who are levered at that time, how the currency ends up, how interest rates play out in the middle, there is some mayhem coming. And in that period, you will find these 5P stocks also, let me tell you.
Okay.
So be prepared. Just stay alive. So be nimble, be agile. Today, I would not think linearly in terms of a company for 20 years, because the underlying force of gravity is going to change in the world.
Got it.
Does a dictatorship run well? The economies in the world which do well are democracies.
Right.
And in a democracy, there's a concept of first among equals. You don't want a presidential form where one guy becomes a dictator, but you're all elected and you elect your leader. Like in our case, Vallabhbhai was, elected leader. You can call 4 partners, but eventually there's one leader. But then the 4 is a council where you want that diversity of opinion to come. Like, why has India survived for thousands of years with domination by, Afghans came, then the Mughals came, the British came. Why did the culture stay alive? Because there was that diversity. And that culture was so strong that it kept the country growing through this. Other nations also got taken over, whether in Latin America or in Africa, and they've lost. They are completely dominated by, the Europeans and their civilization. So we like to think of ourselves as that kind of family, which in theory, we don't run a business together, but we are still joined very much as a partnership.
Got it. So speaking of investment as a profession and investment as a business, like you wanted to shed some light on that in the earlier part of our interview, and you did that as well.
I did in passing, as you recognize that when you're running, a fund or a PMS or whatever, which is measured quarterly, and then there's this army of investment advisors who they will track you every quarter and say this fund did this and that fund did that, and this is the risk they took and that's the thing they did. You're distancing the person more and more away from the underlying investment, and it takes on a life of its own. And in aggregate, if you take the fees, the fund managers and the investment advisors and all that charge, you're taking away from the underlying return that the business is earning. And in that process, as a fund manager, also remember your brief, because I was on that side as well. Your brief is to stay invested. That even in a bubble market, if let's say I was a fund manager and I had sold that famous case of ZTV in 99, and the stock goes up 20x in 3 months, I would have lost my job, right? And the reverse also happened, that if you sold out too early and then you're sitting on cash and the market again rockets, like it could be the case today, again you would lose your job. Like today, there is a fund which sat on, I think, 17% cash, which is showing up very well as a value investor. But say for some unforeseen reason, the market again rockets up. Even people are going to withdraw from that fund.
Right.
So if you can manage to build a reputation where you can run your business as a private company and have public capital, which is the structure, say, Berkshire Hathaway created, or there is someone like a Pulak Prasad who's created that sort of structure in Nalanda, where you have stable money, and actually his big advantage is he can draw in money in a crisis. A lot of people won't have cash to give you in a crisis. Imagine you calling your clients when the market has crashed and say, now send us some more money. And he'll say, are you crazy? Where do I get this cash from? So for a fund management business, it's really about marketing and client management. The actual investment process matters a lot less. Whereas when you're doing an actual investing job, you're not really a marketer and you don't really think in terms of how will the stock perform in 3 or 6 months, because nobody knows that. Even the greatest of all investors, Warren Buffett, doesn't know that. So how do we assume that we are all adding value as fund managers in this market? And that's why in the more evolved economies, the market's gone completely towards index funds and passives. And even in India, I've said this often, that most people who would be working in their own profession or their business are better off buying an index fund for maybe 60-70% of their assets, and the remaining to give you that top up is the mid, small, next Nifty, whatever, the next 50, because some of these will eventually come into the index. But I really would like to ask, what gives anyone the right to beat the market? Only if you have something extra, something differentiated, only then you deserve to beat the market. Otherwise, if you make the 14-15% which the market makes, your option was to make 7% in the bank FD, in fixed income. That extra 7 is really the risk and the growth which you're getting from the stock market. But for people to assume that you can make 25% sitting at home, handing your money over to somebody and not knowing anything about it, is a wrong expectation also.
Got it.
So again, if you just come to 2 index funds, large, mid and small is kind of the 2 funds you can hold. And if you have a view on fixed income, because you have to get one view right, is when rates are declining. That's the only time you're going to make money in a fixed income product. Most of the time, if you don't have a view and they're yo-yoing, you're better off in some other product.
Right.
And if you get it wrong and you buy a fixed income fund at the bottom of the cycle and then rates only keep going up, which is happening in the West, you're destroying capital.
Got it. Fair enough. So what is your outlook on the fee-only investment advisory ecosystem in India?
It's the future, because today the seller is paying, and therefore the incentive for the distributor or that advisor is to come and sell you more and more product, because that's how they make their fee. And they keep you invested in that product because that's how they make their trail fee. So eventually I want the advisor to be on my side, which is the right thing. But as a country, we are not very happy paying fees which are very overt. Like even, I'm guessing even if you go to a doctor and he charges you too much, you'll start looking for another doctor. So while it is the right thing, you also need the customer to be that evolved and to be educated to say why it's right to be with me. And at some point, like if you just charge a fixed fee, like a doctor will come and say, I'll charge you whatever, 4,000 rupees for a consult or a visit. And if he saves you from a cancer, he's still going to get only 4,000. So that business is not then scalable. If he saves you from a cancer or a heart surgery, then you're willing to pay that surgeon, 10 lakhs. But your doctor who's giving you advice to stay healthy is going to keep getting 4,000 rupees. So I haven't found how you can crack this dilemma to make that business on scale unless you can automate and then make it a mass business. So you make money on volume of clients, but then the advice will not be differentiated. Right. So maybe the coming of AI tech can, help that business, because clearly there are too many false doctors out there right now charging too much.
Got it. So you think this will evolve in India as well, like the customers will evolve?
What should happen and what does happen are two different things. So I wish for a lot of things. I wish for something like this to happen, but given our propensity, we as Indians are still not so trusting that we'll only believe in one doctor or one advisor, right? We all want to keep it in 3 bank accounts, 6 mutual funds, 7 advisors,
that is still fine. I
So
believe
if it changes, this is the right thing to do.
Right.
I'm completely on board with it, but I'm just reacting to what is the behavioral propensity in our country of people are not yet joining it. It's a long haul business, but if you do it right, it's the most pleasing business. We try to build our investment bank on that basis,
Okay.
right? That we will give only the right advice. We'll walk away from transactions. We will not come and do. But eventually, as your army builds and you have to keep feeding the army, you end up having to make decisions which like, oh, if there's an IPO boom going on, I have to be in the IPO. Like the mutual fund guy, if he's getting inflows, he has to invest in small cap funds because he's getting the inflow. Same thing will happen to your advisors as you build an army of people, and they will then want the incentives and bonuses to be paid out every year. It's often said that size is the enemy of great. So this could be one of those places. I don't have an answer. Maybe someone will crack it, and that business will be worth a fortune.
Hopefully.
Hopefully.
Because there are businesses like Edward Jones, Charles Schwab in the US. and
Which have
other
also
countries.
suffered in the last few years. Yeah.
Right. But then there have been investment advisory businesses
that's
which are worth $100 billion as
That's
well.
right.
Okay, so coming to our last questions, what is your advice to advisors who eventually advise clients in the larger ecosystem?
We are a bit sort of philosophical at the end. We have come to this world to not just to make money or get famous or get more powerful. You've come for some spiritual reason, to learn certain life lessons. And that karmic cycle, as we say, you get payback over here. So if you will do good, eventually good things will happen to you. Now, question is, how long is that eventually? If you think I've done good and it's not going to pay off for 30 years, I'm impatient, it's not going to work. Like in investing, you buy today, you may not make a return. Some people want it every day, some people want it every month. We've gotten to a stage, fortunately, where we can say we can afford to wait a few years. The same thing applies to a business which one is building, that if you think I'm doing good for my clients and I genuinely am meaning them well, and over time, this set of clientele will become larger and larger and larger, like the examples you gave abroad, and that behavioral change also comes, that is the right way to go forward. In any case, you should go home with a clear conscience, so you get a good sleep at night. And a lot of people, I know you all, in your last report, you all did this study of bank RMs and how they were selling product, which they had no clue of. I mean, either they are ignorant or, they are part of some larger incentive plan. And that can't be a great way to lead your life. So do what is right. Eventually, you are a brand, you are a soul, and you owe it to yourself to do what is right for yourself and the customer.
Right. Thank you so much, sir. This was all from our side. Is there any closing note that you want to give?
No, great. I think we do have as a country, great times ahead of us. We may be in a correction now, but it's a young country. I think we're still 27, 28 average age. We're still at $3,000 per capita. We should be getting to maybe 3-4 times of this size. So there are a lot of opportunities. And if you keep the patience and you keep the faith, it's a country which has allowed us to grow 100,000 times in the last, 35 years. And that opportunity lies ahead of you. So be patient. So we have, good times ahead of us as a country because while we may be going in a corrective phase, remember the index started in 1980 as base of 100 and we are at 75,000 today. We guys have done probably 100,000 times our capital in 30-35 years. So that opportunity still is there in India where we go from a $3,000 per capita economy to a much larger economy, 3-4 times the size in the next 10-15 years. And the amount of wealth creation which is possible over here is all ahead of us. So if you stay patient and disciplined and don't take debt, don't do derivatives and F&O and all that rubbish, there is enormous capital which lies ahead. And the cultural underpinnings of our country that you're not just making money, but you're leading really a good Sattvic life. That lies ahead of us. We're a young country, 27, 28-year-old average age. So the next 20 years is just fantastic period for us. So I just wish everyone well. And I hope someone will find this talk useful.
Definitely.
And take some life lessons.
Thank you so much for your time and sharing your valuable insights, Manish sir. It really means a lot to us. So the 3 key takeaways from our conversation with Manish Chokhani are that 1, you still need to find value bets. Nothing beats like value in investing. fine, there might be good businesses who are trading at expensive valuations, but as an investors, you should pass up them. Second is that there's a world order reset in the cards. There is going to be a currency order reshift, and investors must be careful about it. While having said that, Manish also believes that India's time is yet to come, and there's still a lot more that's going to happen in Indian equities. And the third one is that he looks at investors from a Baniya Brahmin lens. He invests with those entrepreneurs who have the knowledge of Brahmins as well as the execution and managerial capabilities of a Baniya. Hope you enjoyed this conversation. If you did, do hit like and share this with your friends in the relevant circle. Thank you.